Well, to ensure my wife did not get scammed by her friends, I'm going to have a check on AON financial statement. Starting off with balance sheet. We are checking 7 metrics. Out of the 7, only 2 metrics got good score. You look at their cash and the debt. The cash on hand, it's just not enough to cover all the debt. It should be higher, much higher. It means they aren't flush right now. And that whole debt-to-equity picture, it tells a story. AON uses a lot of debt. A huge amount, actually. Their average is way over the benchmark. They're financing things with borrowing, not just pure equity. It makes the structure fragile. But here's a good point. A very strong signal. They have 0 preferred stock. None. This is excellent. It means they aren't relying on these expensive, complex shares. They fund themselves without needing that kind of help. That's clean. Then you look at growth. Long-term growth. Retained earnings. This is where the story gets rough. Their ability to grow, it's actually been shrinking, especially when times are tough. The growth metric is severely negative. That's a huge flag. And share buybacks? 0 on the 10-year average. They haven't actively been retiring shares. So, no boost for shareholders from that tactic. That's disappointing. Now let's flip it. 2 shining stars. First, return on equity. ROE. It's massive, consistently high, way over the goal. This is the good news. It proves they are brilliant at turning shareholder money into profit. Extremely efficient. But the second metric, return on total assets. ROTA. It almost makes the cut. Almost. It sits right at 9%. Just missing the 10% target. They're good at using their assets. Very good. But they aren't great. Not by our benchmark. So, the summary is mixed. High debt. Poor growth. But incredibly efficient with shareholder equity. A fascinating profile. Next is income statement. We are checking 9 metrics. Out of the 9, we got 5 metrics with good score. First, look at their gross margins. They are perfect. 100%. This is incredible pricing power. It means their cost of delivering the core service is almost nothing compared to the price. Pure genius. But selling that service? That gets expensive. We look at SG&A, selling, general, and administrative costs. They are high. Way too high. It shows the product doesn't sell itself. It requires a lot of manpower. Lots of marketing. Lots of infrastructure to push. It takes a bite out of that incredible margin. Research and development is simple. It's basically 0. This is a good sign for a brokerage. It tells us they have a simple business model. No need for complex, heavy R&D spending. It's all about people and advice. Let's talk debt again. We compare interest expense to operating income. They're right on the edge. Just missed the goal. It means their debt is just manageable. But the cost of that debt is eating up a significant chunk of their operating profit. It makes them vulnerable. Tax credibility? They pass. Their effective tax rate is totally normal. No funny business. They pay their fair share to the authorities. That's a good anchor. Now the bottom line. Net profit margin. They want 20%. They hit 16. So, they're profitable. Very, but not competitively dominant. That missed 4% shows their competitive advantage isn't quite as wide as the best in class. But earnings per share? This is pure good news. It's positive, consistently growing, and the growth rate is strong. Double-digit growth. It easily outpaces inflation over the long haul. This company is definitely delivering more value per share year after year. That's a strong indicator. Finally, the debt payoff. Debt to EBITDA. It tells us how long it takes to pay off the debt. They just fail the test. The payoff period is slightly too long. It takes them over 3 years of operating cash flow to clear the balance. It should be faster. So the conclusion is fantastic margins, but high selling costs and too much debt. They are profitable, but the debt slows down the machine. Next is cash flow statement. We are checking 6 metrics. Out of the 6, only 2 metrics got good score. First, stock compensation. Are they diluting shareholders? No, they are very disciplined. The amount of stock they give out is small. It barely registers on the revenue line. That is good news for you, the long-term owner. Now look at the cash versus profit. Operating cash flow. That's money in the bank. We want that number to be bigger than net income. Always. It's the test of earnings quality. AON fails this test. Quite badly, actually. Their cash generation is consistently less than the stated accounting profit. That suggests lower quality earnings. Profit on paper, less cash in hand. Then we look at growth in free cash flow. We compare it to the growth in net income. The cash flow growth is erratic. It means they have periods of very high cash outflow. They might be spending heavily on short-term needs. It's inconsistent. It adds risk. But their core investment spending, their CAPEX, is very controlled. It's a small slice of their net income. They don't need massive, continuous investment in equipment. It's a low capital expenditure business. That's excellent. Finally, capital allocation. Where does the money go? We look at dividends and buybacks, the money they give back to owners. We compare that to free cash flow. They spend more on buybacks and dividends than the cash they generate. 113%. That is a huge red flag. It means they are using borrowed money to pay shareholders or cash reserves. They are sacrificing growth capital for short-term shareholder returns. Unsustainable. So, the final picture is this: disciplined on dilution, low on capital needs. But the quality of earnings is shaky, and they are overspending on returning cash to shareholders. A complex financial profile indeed. From previous study, we know that buying AON can get us 2.9K and QQQ is getting us 3.3K in profit. Seems like buying QQQ is a better idea. Now, it is time to make the conclusion. So, is what my wife said correct? Well, I lost money buying AON stock? By the profit-wise, buying QQQ or S&P 500 is having more potential than AON. At the same time, it does not have good financial health too, potentially not worth your time. Now, the analysis is complete. Once again, if you need a tool for your investment strategy, give a try to stockanalysis.com. They provided sufficient free tools for you to work around. If you ever want an upgrade, promo code is StockSnack. Institutional grade data with less than $1 a day, 1 day, 1 stock. See you again at StockSnack.